Central bank rate cuts. A precursor to economic downturn. Job losses and housing market collapse. Wishing or hoping for cuts to the central bank interest rates? Be careful for what you wish for. Central bank interest rate cuts are a result of a weakening economy and high unemployment. In an October 17, 2023 article in Forbes Advisor and published on Forbes.com, the author Taylor Tepper wrote about understanding Fed interest rate decisions. He explained it in a simple and straightforward manner, writing, "The Federal Reserve adjusts the federal funds target rate range in response to what's happening in the economy. Adjusting rates helps the Fed achieve conditions that satisfy their dual mandate: keep prices stable and maximize employment. Here's how that works. The Fed raises interest rates when the economy starts overheating, too much inflation, and cuts rates when the economy looks weak, high unemployment. The Fed just triggered an interest rate crash. Is it a repeat of 2007? In a Reventure consulting video by Gerli on December 16, 2023, the video analyzes the recent announcement from the Federal Reserve, unveiling its projection of interest rate cuts in 2024. This significant development has triggered varying reactions in the financial markets, prompting the video's creator to delve into the historical context surrounding Federal Reserve interest rate cuts. The central thesis of the video revolves around the recurring pattern where such rate cuts often serve as early indicators of an impending economic downturn. Drawing a parallel to the situation in 2007, the video emphasizes a crucial aspect: the correlation between Federal Reserve interest rate cuts and the subsequent emergence of economic challenges including recessions. The author contends that these bank rate decreases, ostensibly designed to stimulate economic activity, often precede spikes in unemployment rates and precipitate substantial job losses. This historical precedent becomes a focal point for the video, which raises a cautionary flag about the potential ramifications of the current scenario. We see in the graph that recessions are almost always preceded by interest rate cuts. The narrative takes a deep dive into the current economic landscape, shedding light on specific vulnerabilities that compound the concerns raised by the Federal Reserve's announcement. Notably, the article highlights the precarious state of the U.S. consumer, citing a remarkably low savings rate. This revelation becomes a critical lens through which the author examines the resilience of the economy in the face of impending interest rate cuts. Coupled with this is an exploration of the staggering levels of debt, which, over the past decade, have exhibited an alarming doubling trend. The author contends that, despite the anticipated interest rate cuts, this mountain of debt may act as a significant impediment to robust economic activity. While acknowledging the optimistic market response to the news, the author exercises prudence, cautioning against unchecked enthusiasm. The article underscores the need for a nuanced understanding of the broader economic landscape, given the potential ramifications of the proposed interest rate cuts and potential economic downtrend and the devastating rise in unemployment. As this next graph clearly demonstrates, the initiation of interest rate cuts is almost always followed by a spike in unemployment. Similarly, in Canada, recessions almost always coincide with staggering unemployment. The discussion extends to the housing market, where the article notes a discernible decrease in mortgage rates following the Federal Reserve's announcement. However, the author injects a dose of realism into the discourse, contending that, even with lower rates, the anticipated improvement in affordability may not be as pronounced as it appears on the surface. This nuanced perspective adds layers to the analysis, fostering a more comprehensive understanding of the potential impacts on various sectors including the housing market. Euphoria breaks out in anticipation of bank rate cuts. In Canada and the United States, talk of the Bank of Canada and Federal Reserve rate cuts seem to be forecast, on a daily basis, by financial pundits on TV, newspaper articles and online blogs which extol the economic benefits of the central banks lowering rates as soon as possible. It might be worthwhile examining what usually happens during periods that interest rates are lowered by these central banks. In the United States, more often than not, each time that interest rates are lowered, a recession has occurred. Some have been long and severe and some shorter and less severe. However, a recession has resulted in almost each rate-lowering cycle. We'll examine in more detail what a recession typically does to the economy and in particular the housing market during a recession. In Canada, the same is true. More often than not, when the Bank of Canada has gone through an interest-lowering cycle, a recession has soon followed. So, what is worse for the Canadian housing market? Higher interest rates or a recession? Well, as we've seen over the last 40 years or so, both are devastatingly negative events for the housing market. And, while we are still in a higher interest rate environment caused by these central banks' rate hiking cycle, we may want to be careful what we wish for in terms of the central banks starting to lower rates. Central banks normally lower rates in reaction or in anticipation of threatening economic conditions. So, when they start lowering rates, it may not be a time to start celebrating. Rather, it may be a time to rein in spending and carefully watch your financial situation. At that point, the economy is usually on the verge of a down cycle, with all the negative conditions that come with it. Job losses, mortgage defaults, foreclosures and, of course, plummeting asset prices including housing price declines. What is worst for the housing market in Canada and/or the United States? High interest rates and high mortgage rates or a recession? The housing market is a critical component of the economy in both Canada and the United States. It is influenced by various factors, including interest rates, mortgage rates, and economic conditions such as recessions. This discussion will explore the impact of high interest rates, high mortgage rates, and recessions on the housing market in these two countries. High interest rates and high mortgage rates. Interest rates play a significant role in the housing market. They directly influence mortgage rates, which affect the affordability of homes. When interest rates rise, mortgage rates typically follow suit, making homes more expensive for buyers. In Canada, the Bank of Canada's decision to increase interest rate throughout 2022 and 2023 significantly impacted the Canadian real estate market. Interest rates reached 4.5% in January 2023 and then rose again to 5.0% by the end of December 2023. Provinces with the highest average home prices, such as British Columbia and Ontario, experienced significant price dips. In the United States, high interest rates have begun to slow the demand for housing. Morningstar's housing researchers project an 18% drop in starts in 2023. Along with a 5% decline in housing prices, the mortgage market is highly driven by movements in interest rates. Higher interest rates increase the cost of financing across all different segments of the real estate market. Recession. A recession can have a profound impact on the housing market. During a recession, unemployment rates rise, incomes fall, and consumer confidence drops, all of which can lead to a decrease in demand for homes. In Canada, the housing market has not declined since the last recession, concentrating the assets and debt of Canadians in their primary residence. According to the data of the previous years, it is concluded that recession affects the prices of the housing market by an average of about -10%. In Canada in the early 1990s, as unemployment increased due to the recession, the number of houses being sold plummeted and prices nosedived. In the United States, the Great Recession that began in 2007 influenced the real estate environment more than any other occurrence. This period of economic turmoil was caused by what has now become known as the Great Financial Crisis, GFC, which began as a boom in the housing market. Both high interest rates and recessions have significant impacts on the housing market. However, the severity of these impacts can vary based on a multitude of factors, including the overall health of the economy, government policies, and the resilience of the housing market itself. In the case of high interest rates, while they can lead to a decrease in demand for homes and a drop in home prices, they can also potentially slow down a housing market that is overheating and bring about more stability. On the other hand, a recession often brings about a more widespread economic downturn, affecting not just the housing market but the economy as a whole. The impacts of a recession can be longer lasting and more deeply felt. Therefore, While both high interest rates and recessions can negatively impact the housing market, the effects of a recession can be more severe and far-reaching. However, it's important to note that the impacts can vary greatly depending on specific circumstances and market conditions. As such, it's crucial for policymakers, investors, and homeowners to keep a close eye on economic indicators and trends to navigate these challenging situations effectively. What do you think? Will the US and Canada fall off a cliff into a full recession and a hard landing? Or will the Fed and the Bank of Canada be able to orchestrate a soft landing by slowly lowering interest rates while at the same time keeping unemployment from getting out of control? Please join in on the conversation by leaving a comment. If you found this video and information useful, please smash the subscribe button and hit the notification bell so we can keep providing you with timely information you can apply on a daily basis.